welcome to your Monday Futures Market Outlook for December 20th, 2010. This is Patrick Srezna. For those of you that have not had an opportunity to try out eminisource.com, 30-day complimentary memberships are available on the site. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles the market has gone through. We bullishly crossed above that 80-week moving average the other year, and subsequently have seen a market that has pulled back into find support in the summer, and now is finishing that rally on the upside, where we continue to have targets up on the S&P towards the 1300 level going into the first and second quarter of the year. It doesn't mean that there won't be a little bit of a bumpy ride in getting there, but nonetheless, that is our upside target. When we take a closer look at that S&P 500 on the daily charts using the E-mini futures contract, we had the market basically break out of this little triangle consolidation point, and subsequently has now broken above that 1220, 1225 area where the high of the year lay. What essentially then the market has now worked its way higher. We were talking about this 1240, 1242 level right in here as being a key level, because we were looking for a little bit of a market pullback on the downside, but we're still looking for this move to continue on the upside to finish this move to the 1260 to 1300 level. Really at this stage we think that there's room over the next week or two for this to proceed higher, but there will become risk into the first few weeks of January into the earnings season. So we're looking for this follow through to occur over the next week or two, and the longer it takes to develop, if it doesn't, then there'll be a diminishing probability of the move finishing. So we really need to start off this Monday and Tuesday with a little bit of momentum on the upside to see how far we can take the S&P on the upside. Just to review our key points, we are right now intermediate bullish bias. We don't believe that this is a new bull market, but there's certainly no reason at this stage to be looking aggressively to short this market. There's a diminishing probability that we'll have any negative reversals in December, but there is momentum loss and not lack of breath, and we hear a lot of other analysts talking about that momentum loss, but those kind of conditions can last for extended periods as the markets advance in the back of fewer and fewer stocks, but it doesn't mean it can't prolong for an extended period. The next window of risk again is in the first few weeks of January into that earnings season, but beyond that short-term profit-taking risk, we do anticipate this rally can extend all the way into the end of the first quarter, if not early second quarter of next year. So even though we're looking for that weakness in January, it probably will again be another buying opportunity. Next here, I want to take a look at the NASDAQ 100, and more or less here we as well got above that key level around the 2200 area, but the NASDAQ really has not had any momentum whatsoever. None of the major leadership stocks within there, like Apple, have really gained any momentum on the upside on this break, and so really at this stage there needs to be one or two really good stocks that kind of get the ball rolling in the NASDAQ to get this underway. But nonetheless, technically, there's nothing bearish here beyond the fact that there's that lack of momentum going here, which in itself, in the bigger picture, like we were talking about, can down the road have some impacts. But at this stage, we continue to have a target up into the 2250 to 2300 area on the upside. I think that's a realistic target for the remainder of the year. Next year, I want to take a look at the U.S. dollar index futures, and really this is one of the things that is forcing the markets to kind of drag its heels. The U.S. dollar continues to show some strength, and this may at some point have an impact on commodities. We're not immediately seeing it here yet, but if this dollar index can gain any momentum above this 81 level marked off by that blue box, and it really does open that window for a retest all the way up into the 83, 83.50 area on the upside. If we did get that kind of a move, then it certainly will have a pressure on the commodity markets. Next year, I want to take a look at gold futures contracts on the daily charts. We were talking about that little breakdown candles that were sort of breaking the trend line. Really at this juncture, though, there really hasn't been any major violations. And in fact, we still are holding key Fibonacci retracement zones on gold. So theoretically, we cannot rule out the possibility that gold may still go back up and retest the top end of that channel on the upside. But again, a lot of it will play out how all the different commodities start reacting to the currency and price action. But really at this stage, the only way we would be far more negative on gold down to the 1320 or 1300 levels would be any breakdown of that red candle that came down, that shot down and tested that 1360 area. If we see a good reversal of that on the downside, then we can start looking for that testing on the downside. Next, I want to take a look at the crude oil futures contracts using that E-mini crude oil contract, the QM, and more or less we continue to see this flagging formation developing on the upside that wants to roll up. The upside targets for all of these measure moves all lie as high as the 94 to 96 area on the upside, but I find myself being skeptical about the chance that this crude oil move will occur if the U.S. dollar is rallying, and so we're going to be watching, because if the U.S. dollar index is rejecting off that 81 level and is not finding any follow through on the upside and then consolidates back down, then certainly that would be the back under which I would be have more confidence in crude oil making that break above that 91 level and gunning up to 94. But we really risk things like little double top style formations up along this 91, 92, and then reversals or breaks below 87 if that dollar index really rallies with momentum. So I'm sort of I see a nice pattern here that has a bullish implication to crude, but I don't believe crude and the dollar will make the same move. Finally, I want to take a look at the 10-year Treasury note, and when we're looking at the whether it's the middle of the yield curve or the long end of the yield curve that we're looking at here, you can see that overall the 10-year Treasury notes and the 30 years have had very aggressive selling. The bounce came in just under the 119 level. We were looking for support originally around the 119, 120 area, just kind of dipped below there, so we redefined that focal point on the downside. But really at this stage, now that we have a reversal candles coming in, we now have a swing low that developed right in there. So now we're seeing a retracing move on the upside. We in no way would have any inclination to think that this is going to be a bullish move. It's simply a flag or a wedge that is unwinding an extremely oversold market. As this 10-year Treasury bond, maybe there is 1.5 full points higher still from where it is, as it goes and actually does some solid backfilling of this breakdown move. But the more shallow or the less time it takes for this to develop, the more likely it is that this will roll down and begin another wave lower. That certainly could be something that waits until the new year to begin on the downside. So really at this stage, we want to see how far and how high the 10-year Treasury note can really rally on this bounce to set up the next trade. That was your Monday Futures Market Outlook. Thank you for joining me.